Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, June 11th, 2021. And our top story today, the building blocks of a reverse mortgage. Well, joining me now to discuss this and a lot more is Ryan Ponsford with AAG. Ryan, so great to see you. Thanks so much for joining us on the program this morning.
Thank you, Jeff. Appreciate your having me. Thanks.
Yeah, this is a really important topic, and I wanted to have you and the folks at AAG on because the reverse mortgage, it's a financial instrument, a process that I think requires a lot of, I want to make sure that our audience is educated about it. So let's start with, I guess, the proverbial basic question, which is, how do you define what a reverse mortgage is?
Yeah, thanks. So, it's interesting. This is probably one of the most misunderstood tools out there in the marketplace today. The reality is there's a lot of different types of reverse mortgages out there. The basic term is, for the most part, means it's a loan on a primary residence where you have the option of whether or not to make your monthly mortgage payments. So that's the simple version. Within that overall construct of reverse mortgage, the most common is there is a government created and FHA insured reverse mortgage, which is known as a home equity conversion mortgage. And then there's the more proprietary private lender type reverse mortgages, which for the most part come into play if you have more of a jumbo home worth $1.5 million or more. So some of the coastal communities, those come into play. But over 90% of the reverse mortgages that are done are the government home equity conversion mortgage. So that's typically where we spend most of our time kind of breaking down that explanation.
Is there a particular investor profile or customer profile that you mentioned a home of, I think you said $1 million or more, but is there someone that fits this profile with a credit score, certain financial parameters, just to give an audience of maybe something that they could be considering as well?
Yeah, so the way historically people have always talked about this as kind of a needs-based, last resort, all else fails type of a solution. My experience is it can work there, but where the real opportunity is for the more affluent families that are looking to optimize their retirement options. And so for me, from a basic qualification standpoint, it's designed for people that are 62 or over. And you usually look for about 50% or better equity position. So if you have a loan to value where you owe less than 50%, that's not exact. It's kind of a rule of thumb. And as you get older, you can actually borrow more than the 50%. But that's kind of a nice starting point. If you're 62 or over, 50% or better equity position, to me, the real sweet spot is people that, liquid assets in money saved for retirement. They've got, anywhere it could be zero, but really it's 500,000 up to maybe $2 to $3 million set aside for retirement. That is where I see the greatest opportunity to be able to optimize their strategies. It works for people that have more than that. The problem is there's only so much that we can lend based on just some of the parameters of the loan itself. So it's just a little less interesting to people that, have 5, 10, $15 million, but the math still works.
Do you need to have your mortgage paid off? I think you mentioned that 50% threshold of equity, but for those people out there who maybe fit the profile you were describing, do you have to have, someone like my mother who paid off her mortgage, or my father whose mortgage is paid off? Do you have to have that paid off, or can it be partially paid?
It can be anything. Yeah. So you can refinance an existing loan. In fact, most of the ones we do are probably refinances of existing loans. And when you get down to it, and maybe we'll get into this, there's a lot of flexibility in how you take the proceeds, right? Some people are simply paying off an existing loan to eliminate payments, right? So I've now freed up that cash flow of the mortgage payments. Some that have a free and clear home might put this in place and take income streams from it to improve or enhance cash flow. But really the most creative option is there's a line of credit. And I like to explain this as take your traditional loan and simply replace it with a large revolving line of credit with some unique features, right? So if you have an existing loan, you put this line of credit in place, you have the option to borrow, to withdraw, to pay down. You have a ton of flexibility from a payment perspective. You can make monthly payments, you can make quarterly payments, you can make no payments, interest only, principal and interest, whatever you want to do. And you can draw out of it anytime you want. So a lot of flexibilities as it relates specifically to that line of credit. And that really provides a huge number of options for people. One of the really cool things that most people don't realize about the line of credit is it actually has a compounding growth feature, meaning the amount that we lend to you is going to increase every single month. And that happens regardless of the performance of your real estate, right? So once this is in place, I've locked in my real estate value. We lend you a certain amount, and that amount will compound and grow monthly. And I can go through some kind of math examples if you want to kind of hear how that would work.
Yeah, I want to save the process of doing this for the second segment, just to kind of set up things a little bit more for the audience for that next conversation. Mm-hmm. Does this need to be my primary home, or can this be a condo or a townhome that I own, like a vacation townhome somewhere down the ocean, as we say in Baltimore?
Yeah, it does need to be a primary residence. It can be a condo if that's your primary residence, as long as it's FHA approved. But it does need to be primary. That's one of the stipulations of the product.
And I would imagine that there's paperwork. We'll talk about the process in the next segment, but just to kind of tee it up and kind of a teaser, I'm imagining forms and things that you need to fill out. You probably need to show your credit score or certain profile information so that you can be vetted.
Yeah, a little different than a traditional loan, similar from the standpoint of, you have the deed and all those the normal things that you do on a traditional loan. The government product is a government product. So, they like paper. So there's a little more, so some extra paperwork there. From a qualification standpoint, it's a little bit different. While people have the flexibility of mortgage payments, they do still pay their property taxes and insurance. So if you look back to some of the issues that happened to these in the past, where people, you hear headlines, somebody lost their home and it was this awful situation. Most of those, when you look at it, it has to do with them not realizing that they had to continue making their property taxes and insurance payments, which my opinion is partly the fault of the salesperson, right? So you have to make sure they are clear on that. People think, hey, I never have to make a payment again. They get their property tax payment and they throw it in the trash because they think they don't have to do it. Well, years later, that gets bad. So really what you're underwriting more is that, as opposed to a full principal interest payment like you might see in a traditional loan. So the qualification is different. There is some qualification required, but different than a traditional.
Yeah, and that's a perfect segue, Ryan. I want to take a quick break. When we come back, we'll talk about the process to take a reverse mortgage. Ryan's going to give us all the details. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score, a credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Ryan Ponsford of AAG. We're talking about reverse mortgages today. Ryan, thanks so much for staying with us this morning.
I'm still here. Thanks for keeping me around for round two.
Absolutely. And this is not a boxing match, of course. I'd probably lose. But it's education, information for people to really get they've probably seen your ads. They've seen, information about reverse mortgages. What do they need to know about the process, the tactical aspects of actually moving forward with this?
Yeah, thanks, Jeff. So the real thing with this is there's the process of once you're moving forward. To me, the bigger question is the strategy of if or when this makes sense. A lot of people tend to look at financial decisions in isolation. I just am looking at my home loan. I just am looking at my investments. Where I think the real opportunity for people in designing retirement plans or any type of financial plan is understanding how all the different pieces integrate together. And that's where a good planner, a good advisor will help you understand how all these parts fit in. And that's what's fascinating to me about this reverse mortgage concept, is understanding how it fits into the big picture. To address kind of your question of process when you get there, there's some unique things to this particular program that's different than a traditional loan. One is they do go through a third-party counseling. So even though they've agreed to do it, the person providing the loan information said it makes sense, your financial advisor might say it makes sense, they still go through a third-party counselor just to make sure they're aware and familiar with everything. And part of the reason for that is, if you think about it, it's typically an elderly market, and so we want to make sure they're properly protected. There's a lot of safeguards in place to ensure that families are being protected, that they're making the right decision. Oftentimes, this is a big financial decision for people. This is their primary residence. They've, worked their whole lives to save and pay it down. This is probably where we're going to spend the rest of your life, and it's a big decision. So making sure that they are being intelligent about that is mission critical, which is why I think that the more comprehensive perspective of how does this fit into the bigger picture starts becoming critical to ask yourself.
And Ryan, in terms of contract terms, are there different variables that people need to be thinking about? I mean, you mentioned the program or programs, but what types of contract, is it in terms of an amortization schedule, length of time? What are things that people need to be thinking about when they're going into that consideration process of going through this?
Yeah, good question. So it's very similar to a traditional loan with a few exceptions. One is contract term. People ask, hey, what's the term of years for this? It's not necessarily a term of years. It's more based on lifetime and living in the home. So rather than be a fixed 15 or 30-year type of a time frame, you can keep this loan in place as long as one of the two borrowers continue to live in the home. If they move out because maybe they need to go, they have a healthcare issue, they go into some type of assisted living. If one of them moves out, the other one's still in the home, you're fine. When the second one moves out, you have typically up to 12 months to either move back to the home or you have to start satisfying the terms of the loan. So once you're out for 12 consecutive months, or if somebody passes away, you have about 3 months, about 90 days to start figuring out what you're going to do with the loan. You can get extensions on that, typically up to about 12 months, to where you're going to try and figure out what do we want to do with this particular loan. So in most cases, if somebody's passed away, it's the heirs, the kids, however the house is being distributed, are going to decide, do we want to refinance this property and keep it in the home? Do we want to sell it? What are our options here available to us? And there's quite a few different unique options for people as they go through that.
To that end, Ryan, do you see this as part of an estate planning process? And we've talked about, we don't just focus on the mature segment of the population, but we've talked about estate planning and trust. Is this element baked into that process so that if you do leave, unfortunately pass on, and it's going to happen to all of us, unfortunately, I'm not looking forward to that. Hopefully I got some time for that. But do you put that into this process so that your heirs know what your intended wishes are and also what financial instruments are available to them.
Yes, absolutely. And this kind of goes back to that concept of integration. I spent a lot of time with estate planning attorneys, and in my planning practice, did a lot of work with wealth transition, transitioning wealth and things and preparing the next generation. As I'm sure you know, and your listeners would know, that communication is probably the most critical part of that entire process. So ensuring everybody's informed over what's been put in place and how that'll look, at exit, I think is critical. With the reverse mortgage, it's interesting. There's definitely some estate planning considerations. Some of the unique things, it is a non-recourse loan, which means in the event you put this in place, you never make a payment for years, and let's say we see a downturn in real estate, and now you end up in that situation where you're upside down. You owe more than the home is worth. As a non-recourse loan, the lender can only go after the collateral that's been pledged for the loan, which in this case would be the primary residence. So they can't go after other assets of the estate or the heirs or anything else, which is important. The other important thing is if they are upside down and that there's that deficiency of debt. As you probably know, in a short sale today, if that loan is in theory forgiven, if somebody does a short sale, they're actually going to get a 1099 at the end of the year, which is a taxable event. In this case, that does not exist because it's non-recourse, and the FHA insurance policy is actually going to pay off that difference. So those are two things. The third kind of interesting thing, and probably least known part of this, and this is sort of a fascinating, we get really in the weeds here, but if you think about it, if somebody, let's say they refinanced their previous mortgage, and so they had what would be considered acquisition indebtedness. The original loan was used to acquire or even improve their home. That interest on that loan is tax deductible, right? Most of us have traditional loans. We deduct the interest at the end of the year because we're making interest payments. In this case, most people don't make payments. So if you're not, that interest is accruing. So a lot of people don't realize you can fast forward 7, 10, 15 years down the road, mom and dad maybe pass away and the home gets sold and that loan gets paid off. You may have years of accrued interest. So we had one recently where a family had over $100,000 in accrued interest that was deductible to the estate. And I'm not a CPA, so not tax advice, but as I understand, that is actually a transferable deduction where that could be transferred to the kids. And I believe that's under the income with respect to decedent rules. And so there, from an estate planning standpoint, there could be some very interesting tax planning opportunities for what to do when you exit this, because you have to, there's no carry forward on that deduction. So you actually have to use it in the year in which it's realized. And so we've seen people do that where they might have an IRA where they take a distribution out of that in order to use up some of that tax deduction. But it's a very commonly missed opportunity that I think is something to have a conversation with your advisor or your estate planning attorney.
Yeah, really, really good advice there. And I'm not a CPA either, for whatever it's worth. Last question, we've got about a minute left in the segment here, Ryan. The fees associated with doing this, I'm assuming it's almost like when you get a mortgage or you refinance a mortgage, there are fees associated with that. Are there fees associated with doing a reverse mortgage?
Yep. A lot of people hear, hey, these things are expensive. So there are some unique expenses in this that are not to a traditional mortgage. A lot of it's similar. You have title, escrow, all those normal refinancing costs. The one thing that's unique is when you, in an FHA government loan, if you think about a traditional loan, you have often the PMI, private mortgage insurance on some loans. Similar to that, we do have a mortgage insurance premium that gets paid. So essentially what's happening is the borrower is purchasing an insurance policy from the FHA in order to guarantee their ability to stay in that home. It provides them the ability to stay in there, not make payments, again, even if the loan surpasses the home value. It allows them to access their credit line if they want access to it. And again, the credit line can grow beyond the value of the home and they can still access that. If they set up a monthly income stream, it allows them to guarantee that income stream, again, even beyond the value of the home. And there's also a thing where the heirs, if you're upside down, the heirs actually have the option to purchase that home at 95% of the appraised value, even if it's upside down. So that's really what that policy goes into cover. The way the expenses work on it is there's two ways that those borrowers pay in to that insurance fund. One is a one-time initial mortgage insurance premium. So when the loan closes, there's a one-time expense that they pay, and that's based on 2% of what we call max claim amount, which is essentially the appraised value capped at the FHA limit, which is currently $822,000 and change. So for example, if you have a $300,000 home, that one-time expense will be $6,000. Okay, so that's financed into the loan about 95% of the time, right? The second way that people pay into that insurance premium is going to be in the internal rate. So we look at the rate on these loans, which, by the way, we're in a pretty unique situation. Normally we run a little bit higher than traditional loans. We are at or even lower than a traditional loan rate today, which is pretty unusual. But built into that rate, 50 basis points of that, the lender is paying into that insurance fund as well. So that's just on whatever's outstanding on the loan, not the full credit line, just what's outstanding. So those are really the two things. There's an origination fee that some lenders will charge. That's statutory, as there's a max they're allowed to. But other than that, it's pretty similar to a traditional loan.
Well, Ryan, this was extremely helpful. I found it educational. And after seeing all the commercials, I feel like I understand the vehicle a lot better. Ryan, we're going to leave it there. Really appreciate you coming on the program today. And thanks so much for joining us. We look forward to having you back again very soon.
Thanks, Jeff. Appreciate you. Lots more going on in these things. So yeah, we'd love to do it again. Thanks again.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN Weekly. We'll have a very special guest, and we'll take a look at some of our best segments for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.